Good morning, students. We are on chapter number 9 of account part 2, that is accounts for non-trading concern. And today in this lecture we are going to talk about the classification of expenses of a non-trading concern. Topic is classification of expenses of non-trading concern, meaning of deferred revenue expenditure, which is also part of expenses. Classification. Expenses are of three types. One is capital expense, second revenue expense, and deferred revenue expense or expenditure. So one by one we will talk about them. First of all, capital expense. Friends, we have seen the meaning of capital incomes, where we have seen that capital incomes are those incomes which are not regular in nature. The same thing is applied in capital expenses. They are not regular in nature. Expenses which is not incurred regularly and the benefit of which is available to the concern for longer period of time, from which fixed assets are acquired by the concern, is known as capital expense. For example, land building, machineries, investment, books of library, X-ray machines, sports equipment, swimming pool, etc. Capital expense is disclosed at the asset side of balance sheet. We have seen that capital incomes are shown at the liability side, so capital expenses are shown at the asset side, and normally from capital expenses assets are acquired. Apart from the purchase price of asset, its installation expense, its stamp fee and document expenses, expense incurred to increase efficiency of the asset are also capital expenses, which are added to the cost of respective asset. Let us talk about the revenue expense. Revenue expenses are the expenses which is incurred on regular basis to run a routine activity of the concern, and the benefit of which is available to the concern for the respective year only, is known as revenue expense. For example, daily administrative expenses like salary of employee, rent paid, taxes, postage expense, telephone expense, stationery printing, entertainment program expense, subscription of newspapers and periodicals, asset repairing expense, depreciation on asset, ground maintenance expense, etc. So revenue expenses which is regular, routine. Let us see the difference between two, capital expense and revenue expense, which will make the concept more clear. Meaning, an expense which is not regular, which is not incurred regularly, and the benefit of which is available to the concern for longer period of time, and through which the concern acquires fixed asset, is a capital expense. Revenue expenses are expense which are to run the routine activity of concern, expense which is incurred and the benefit of which is available to the concern for current year, is known as revenue expenses. The objective of capital expense is either to acquire fixed asset and with their help to create facility to generate income, and objective of revenue expense is to run activities of the concern, to run the routine activities of the concern. Third, presentation in accounts. Friends, we have seen that capital incomes are shown at liability side and capital and revenue incomes are shown at the credit side of income and expenditure account. So the same way, the capital expenses are disclosed at the asset side in balance sheet, and revenue expenses are disclosed at the debit side of income and expenditure account. Some more points. Fourth one, every year the balance of capital expense is carried forward and balance it as an asset, and balance of revenue expenses is closed by transferring it to income and expenditure account. Examples: fixed asset purchase of land, building, machines, furniture and their installation expenses. Revenue examples or illustrations are routine administrative expense like salary, postage, stationery, rent, etc. So friend, this was all about the capital and revenue expenses. Let us talk about the third type of expense, which is deferred revenue expense. Here it is. The benefit of revenue expenses is for that respective year in which it is paid, but there are certain expenses for which the benefit is available in certain subsequent year along with the year in which they are paid. Thus, instead of writing off these expenses as revenue expenses of that year in which they are incurred, they are allocated over estimated number of years for which benefit is available, or allocated to the predetermined number of years. This means they are written off proportionately. This expense is known as spread expense or deferred revenue expenses. So basically the meaning of deferred revenue expenditure we have seen since beginning of our accountancy subject. From first chapter we are learning this, the expense whose benefit is available for more than 1 year, more than current year. Next, the amount written off is disclosed at the debit side of income and expenditure account, and the portion of this expense which is not written off is disclosed on the asset side at the end of the balance sheet. For example, building color work, ground leveling expense, etc. So friends, this was all about the expenses of non-trading concern. In next lecture we will talk about the next topic. Thank you.